Welcome to the classroom session of Safal Niveshak. There's an old saying, when in Rome, do as the Romans do. What this saying suggests is that you need to know the language and customs of people when you visit an unknown society. Doing so is polite and also advantageous. The same holds true when you enter the investing society. Before you enter, your gate pass must show that you understand the language of business. And what's the language of business? Well, that's financial statements. So let's talk about the basics of financial statements today. Financial statements. Financial statements actually speak the language of business. By knowing how to read and analyze financial statements, you will be able to first understand how has been the performance of the company. So financial statements talk about the performance of the company. The second aspect of understanding financial statement is to know how profitable is the business. So first is performance, the second is profitability of the business. So financial statements go a long way in telling you how profitable the business is. The third thing that financial statements help you understand is the difference between a good and a bad business. So good versus bad. So your financial statements can easily tell you what kind of business is good and what is bad, and something that you must avoid at all costs. The fourth aspect that financial statements lead you to is to identify potential scam companies. So by reading of financial statements, you can find out a lot of shenanigans that exist within them, which can really bankrupt a company in the future and which might not be good for your portfolio. So financial statements can help you identify potential scam companies. And the fifth aspect that the financial statements tell you about is the companies that you own. Are there any duds within them? So it might happen that you must have bought a company without analyzing the statements, and now once you get to read the statements, you identify that some companies are really duds. So an analysis and understanding of the analysis of financial statements can really help you find out dud companies from among your portfolio stocks, which you can really sell. Basically, financial statements paint a picture of the transactions that flow through a business. Each business transaction, for example, whether it's a sale of a product or a service or use of a rented office space by a company, it contributes to the whole picture, how the company looks like. So in this video, let me take you through a simple approach of understanding the three financial statements. So what are the three financial statements? The first is the balance sheet. The second financial statement, important financial statement, is the P&L account, also known as the profit and loss account. The P&L account. And the third statement, and also a very important statement, is the cash flow statement. The cash flow statement. So these three financial statements actually form the backbone of a company's financial analysis. And if you can understand how to analyze these financial statements, you will go a long way in terms of your investing career. And it's not very difficult, as we'll understand the analysis of financial statements. It's not really difficult to understand the key aspects that you need to look at while analyzing these financial statements. So let's understand the financial statements in a few simple steps. Let's assume you want to start a restaurant business. Yeah? For that, you need to buy a place first. So what do? The first thing that you need to do is raise capital. Now, how do you raise capital? So we'll talk about raising capital now, the first step in financial statement analysis. So you raise capital. Capital is money that you need to infuse in your business. So how do you raise capital? There are two ways of raising capital. The first is debt, which means the borrowings that you make from banks, and the second is equity. Equity is either the money that you yourself fund into your business, infuse into your business, or the money that you can raise by issuing shares and then taking the money from others who buy the shares. So these are the two ways of raising capital for your business. If it's a small business, the equity can, as I said, the equity can be your own savings that you put into the business. Otherwise, you can float a company and issue shares to raise equity capital from the people. So you raise capital using these two methods, which is debt and equity. Now, even debt can be of two types. So let's look at the type of debt. The first is current debt, and the second is long term. So you have two kind of debts. The first is the current debt, which is also known as current liabilities, and then you have a long-term debt. Long-term debt, which is mainly long-term bank borrowings that you need to repay in a period which is above 1 year. So you have current debt and long-term debt, and these two are known as liabilities. Liabilities. So you have current debt and long-term debt, which is liabilities. Equity is known as shareholder equity, so there's no segregation of equity like we've done of debt. Now what happens? What do you do of the money that you've raised via debt and equity, right? You use the capital to buy assets. This is the money that you've raised to start your business, the debt and the equity you've raised to start your business. So what do you do with that? You simply use that money to buy assets, right? So this capital you use to buy assets, right? Now what are assets? Assets are the properties, the plant and machinery, the equipments, the current assets that you own in your business and which are used for daily operations of your business. So the kind of assets, as I mentioned, can be current, and then you have fixed or non-current assets, right? So your fixed assets mainly include your property, the land or the building in which your restaurant is located, the equipments, that you use in your restaurant, for example, to cook food, the furniture that you use, the utensils, examples in a restaurant business, etc. And the current assets are, for example, the inventory, the fruits and vegetables or other raw food that you use in a restaurant to make final finished product. That's an inventory. And also cash that you have, for example, cash lying in your bank account, the current account of your business. So these two are the assets that you fund. These two are the kind of assets that you fund using debt and equity to run your business. Now once you acquire these assets, for example, you acquire inventory, you acquire property, you buy equipments, furniture, utensils, what do you do with these assets? Simple. You start selling your service. You open up your restaurant and you start selling your services. So these assets are deployed to create income that brings in cash to your business. So these assets are basically used to generate income and ultimately profits for your business, right? So if you go back to what we discussed, we've talked about raising capital, which is debt and equity, and also using the capital to and also segregating the capital into current capital, which is current liabilities and long-term liabilities. So this is the money that you've raised, and you use that money to create assets for your restaurant business, and the assets can be current assets and fixed assets. Now use those assets to generate generate income and ultimately earn profits. So we've looked at the balance sheet side of the financial statement, which is debt, equity, and liabilities and assets, and from that we use that money to, or use those assets to generate income for us and also subsequently profit. So which is a basic of the income statement. So income statement really talks about the sales that you made in a particular period and the profits that you've earned in that particular period after paying out all your expenses. So this is the basic of the balance sheet and profits. Now the most important thing for a business is cash. So profits ultimately do not mean cash, because there are a lot of other expenditures that the company needs to make, and we'll talk about that. So we'll simply understand what's a cash flow. How does a cash flow a company? So let's talk about the cash flow amidst all this, right? So we'll talk about the cash flow. How does the cash flow? The business borrows capital, it uses the capital to buy assets. So it raises capital, it uses that capital to borrow to buy assets, and uses the assets to generate business. So you have three stages that we've already seen. Now look at how the cash flows between all these different segments of balance sheet and income statement. So what we did in the first place? We raised capital using debt and equity, so which is like a cash inflow for the business, right? So the cash flow, a very simplified version of cash flow, you have plus cash of sell equity, and you have plus cash of issuing debt, right? So these are the two ways that you have seen an inflow of cash into your business. Now what do? You buy assets, right? So let's look at in a different color. So this negative cash because you have bought assets, so you buy assets out of the cash that you've raised. What else do? You buy inventory, the raw materials that will help you run the business. So for your restaurant business, might be, as I said, raw food, vegetables, fruits, all those kind of things. So we saw first two points: adding cash to the business, selling equity and issuing debt, and then you use that cash, which means there's a cash reduction from the business when you buy assets and when you buy inventory. So that plus shows a addition of cash, inflow of cash in the business, and the minus shows an outflow of cash. So as we understood, what do we do after we have sold equity, we've raised capital, we've bought assets and inventory? We make sales. So there's sales in the business which brings in cash, right? So when you sell your services, when you sell the food in your food and beverages in your restaurant, you earn cash. So that's a positive thing. But then you also have to pay expenses, right? So expenses mainly will be salaries, right? Plus then you'll have raw material cost, you have some marketing costs. So all these are expenses which take cash out of the business. Again, you also have to pay the regulatory taxes. If you're making profits, you have to pay taxes. So in the P&L, sales got in cash inflows, then there was an outflow because of expenses and taxes. This is not enough. The business, because as we saw, it has raised debt. So it has raised debt, which means there has to be an interest payment. So the business, your restaurant business, also needs to pay interest. Plus, since you've also borrowed money, you've also actually got money, or if you infuse your own money via equity, there has to be a payment to equity. The payment to equity is called dividend. So you pay a dividend to equity holders. What remains after that? So you have cash, a net cash after all your inflows and outflows. What remains after that can have again two kind of uses. One is you can use this cash to repay a part of your debt. So let's see, you can use the cash to repay part of your debt, or also you can use a part of the cash to buy back equity. So you give money, cash back to your equity investors and buy back the shares from them. So you own the shares now. The third use of the cash that you finally have earned from the business after paying all your expenses and interest and dividend, everything, can be used to buy more assets, right? So another use of cash is to buy more assets. More assets again here would be, for example, you need to probably open another outlet or another restaurants in a nearby location or in a different city. So that's to buy assets. So this is the utilization of cash, and this is the way how cash flows. So I'll review again interlinkages between the balance sheet, the P&L, and the cash flow statement of a business. The first thing is when you raise money. So you raise capital, then you capital can be either debt or equity. So capital can be either debt or equity, and then you use that money to buy assets, because you need to operate a business, so you need to buy assets. Assets can be two kind: current assets and fixed assets. And we've discussed current assets and fixed asset, and I'll discuss more about these in future videos. But for the time being, understand that these assets are then used to run your business, to earn money via income, and to finally earn a profit. Now when we look at the cash flow statement, so we've talked about the balance sheet and the P&L. Now when we look at the cash flow statements, we've seen an inflow of cash using when we sell equity or when we issue debt. So there's an inflow of cash. Using that cash capital that we've raised, we buy assets, so there's an outflow of cash. We also buy inventory, raw materials, which is an outflow of cash. Using those assets, we make sales, so this is an inflow of cash. But we have to pay expenses, which means there's an outflow of cash. We also need to pay taxes, which means there's an outflow of cash. What remains? We also need to pay interest. Interest is a compulsory payment, so even if you are earning losses or if you are making losses, you still need to pay interest. So that's the negative side of companies that have a lot of debt, because they, despite all the problems that they incur, that they face during slowdowns, they need to pay interest. So you need to pay interest, negative cash, which means the cash outflow, and you also have to pay dividend. It's not compulsory, but if there are equity investors, you generally pay dividend to them. And what remains with you? Cash. So that's a cash. It can be a negative figure or a positive figure. If it's a negative figure, you need to borrow more money to invest in the business, which is bad for a business in the long term. If it's a positive figure, you can use that positive figure in two ways: either to pay off your debt or part of your debt, or to buy back shares from equity investors, or a third way, which is a very important way, is to reinvest in the business, buying assets, buying inventories, or for example, when you are looking to plan, or you're planning to open a new restaurant or expanding your capacity. So this was the basic of financial statements. I've tried to make it as simple as possible. If there's any problem, you can always write into me. I've seen a lot of people. I met a lot of people who ask, is there a way I can invest without understanding financial statements? Because for them, understanding, or for most people, understanding financial statements seems like a very tough thing. Of course, there's a way. Yeah, there's a way, but it's very much like climbing Mount Everest without knowing mountaineering. So you might still reach the peak, but the chances are minuscule. You know that, don't you? Anyways, I hope today's video was helpful for you in understanding the basic working of the financial statements and the interlinkages between them. Let me know your feedback on the same. Thank you and have a nice day.